roads, water and sewage systems, ports, and railway lines. Big-ticket infrastructure items that all countries in Asia will need to invest in to maintain growth momentum, tackle poverty, and respond to climate change. The price tag for developing Asia, according to the Asian Development Bank, is a massive $26 trillion from 2016 to 2030. That works out to $1.7 trillion per year. The COVID-19 pandemic has inflated the bill further.
There are two drivers. One is because there is some extra investment demand into some social sectors like healthcare, sanitation, and then also there is more demand to invest in ICT-related infrastructure. So this definitely causes more investment in this area.
The need to fund infrastructure is growing. At the same time, government coffers are being depleted as they pour in money to help their pandemic-hit economies.
COVID, of course, there are no specific numbers available, but undoubtedly that would have delayed some of the required investments over the past year. Traditionally, of course, this has usually been funded by the public sector, usually governments in, of course, their own countries. But the scale of the numbers themselves does highlight that will be difficult to fully plug that gap through that one source alone.
The money for infrastructure projects will thus have to come from the private sector. The banks will not be the key source of financing, though. Industry players say relying on banks for financing is not healthy practice.
One of many problems that led to the Asian financial crisis, because at that time, the bond markets across Asia wasn't vibrant, and much of the debt burden was held by a handful of banks. So when there's stress, the handful of banks couldn't hold it, and the domino effect led to what we saw as an Asian banking crisis then, and the folding out of many banks.
This increases the need for the region's capital markets to take on a bigger role in infrastructure financing. Asian firms are already issuing bonds, which are denominated in the G3 currencies, the US dollar, the euro, and the Japanese yen.
Talking about the G3 bond market itself, it has been issuing. Last year, it crossed maybe 350 billion US dollars, and it's still in its nascent stage. The fact that it is still growing is in itself a sign that there is more potential, and as a result, more appetite for the market to be able to accommodate the infrastructure debt financing needs that's to come. You compare Asia to the other markets in US and Europe, the new issuance volume here is even though it's been growing at quite a healthy pace, is really very, very small compared to what you're seeing in the Euro and the US market.
There is even scope for the region's capital markets to expand further to include bonds, which are denominated in the local currency of each country.
There are some benefits of local currency bond markets. For example, it helps to mitigate currency and maturity mismatch, which actually caused the Asian financial crisis.
So one thing that is critical for capital markets development is to make sure that you have the liquidity that is needed for the investor to be able to sell the instrument in the market whenever they think that it is the right to sell it.
It will take time to build up liquidity in local currency bond markets. To that end, Singapore expects to issue its first tranche of the SGS infrastructure bonds in the fourth quarter. The bonds will be created under the Significant Infrastructure Government Loan Act, or SINGA. The proceeds from SINGA bonds will be used to fund major long-term infrastructure projects, such as new rail lines and coastal protection projects.
SGS infrastructure that will complement the SGS market development in a way, and will help the government to target the issuance of bonds to a specific objective. And the objective here will be a long-term finance for infrastructure. So in a way, it will allow to deepen the capacity of the government to really invest into a specific product. No? And I think that the capital markets in the world are going more and more in that direction. If you look at the spectrum of instruments that we have in the market, green bonds, impact bonds, social bonds, so there is a clear ask or request by investors to target the bonds that they buy to the final objective of that bond.
Singa bonds are actually plain vanilla bonds backed by the Singapore government's balance sheet, unlike traditional infrastructure project bonds, which are backed by infrastructure projects. Further ahead, industry watchers say Singapore can issue such pure play infrastructure project bonds.
It absolutely sounds quite interesting. I think it will also be important to test, the investor appetite for this sort of more long-term, more structured sort of issuance. But absolutely, when you think about developing the Sing dollar bond market, these are the kind of steps in the direction the market has to go in.
Singapore's experiment with Singa bonds holds some lessons for other countries in the region.
Not many countries have the fiscal capacity to issue this type of instrument for different reasons. One, because when you create an asset class like this one, you need to ensure that you can issue a minimum volume that will provide the investor the certainty that they will be able to sell at some point in time, or that they will be able to value the bond with market values, etc. No? So you need to have liquidity. Maybe also they don't have enough buyers on the other side.